So good morning, everybody. Thank you for joining our webinar, which is the fifth part of our NORDIC VC Masterclass that EstVCA and Startup Estonia are doing together. I am Kadri Lindpere. For those who don't know me, I'm the Managing Director of EstVCA. And today I am super happy to welcome our Norwegian colleague, Chris Rangen, to do this masterclass for us, as well as Rasmus Udde from Sunly Future Ventures. So I will give word now to Chris to introduce himself, and super happy to have you with us. Welcome.
Thank you very much, and good morning, everyone. So my name is Chris. I am joining you from the not so sunny west coast of Norway, where we have snow, ice, and a really thriving VC ecosystem. And I'm joined by my good friend Rasmus. So some of you, or many of you, may probably know Rasmus, and I'm very happy to kind of get this international collaboration and international joint session we're going to be working with you today. Now, in terms of how we'd like to work, we do encourage questions, comments, input, objections, rejections, anything that you guys like during the session. We're going to stop and ask some questions along the way. We're going to have plenty of time for questions, but we do encourage you guys to engage and discuss in any possible way. So the topic that we have before us is structuring a VC fund, which we are going to explain through what we call the fund journey. We have some thoughts about how different funds can work with CVCs, so corporate venture capital, in different ways. And we're going to dive into what are the different practices and what are good practices and what are maybe great practices for CVC units. And especially Rasmus and I will be sharing some ideas and some experiences to that regard. Now, let me kick off with a couple of points. Introduction. So today we're not going to be doing any slides. We're going to be using a interactive Miro board, and I'm sure many of you are familiar with how that runs. But basically, everything that we show you will be made accessible to you afterwards. If there's anything that I reference or anything that I show that you want to have a copy of, please let us know, and we'll make sure that you get that in your inbox. Now, very briefly about me, I get to do a lot of very interesting things. And I probably have one of those I have the best job in the world type of things. So my day job is working as an advisor to different funds, VC ecosystems, governments, ministries, different national venture associations, different national fund of funds. And in recent times, I have worked with around 200, going towards 250 funds, mostly across venture capital and private equity. And these are global funds in Africa, Asia, Latin America, North America, and of course, Europe. I also get a chance to teach quite a bit. One of the things that we've been developing is probably the world's largest open and free digital academy for fund managers. This one is funded by technically the UK government. And it's about accelerating the next generation of gender smart fund managers globally. I also do several accelerator programs for GPs. So I think everyone on the call here is familiar with traditional startup accelerator programs, typically the 3-month, get some funding, get some equity, etc. We've been building several accelerator programs for general partners. We run these globally. So we have one just completed for Africa. We have one running right now for Asia Pacific, where we have impact funds, we have ocean funds, we have deep tech funds, we have sustainability funds, we have consumer funds, really, really interesting, diverse fund managers. And we run that as a 6-month program. So here's a couple of photos from probably last week. We were working in Singapore, where we bring together the managers, we bring together different LPs, and we bring together the capital allocators and the investors, but in quite different formats. And we bring the right people in the room together in ways that would be maybe a little bit more challenging to do individually. I also get the chance to teach. So one of the things I'm teaching is to teach venture capital at London Business School. They have something called the Newton Venture Program, or the NVP. If you are looking to kind of upskill yourself within the world of VC, I would really encourage you to take a look at the Newton Venture Program at LBS. And here you can see us. This is back in June. We were running what we call a fund manager deep dive, or fund manager simulation, where we effectively take the participants through a roughly 15-year fund in roughly 15 hours. So we make sure that people get to experience that full fund journey, where they have to define the thesis, set the strategy, build a team, raise the fund, find the LPs, develop the deal flow, make the investment, build a portfolio, do all the value creation, handle all the bankruptcies and the founder blowups, and then eventually work towards exits and distributions back. And what we can do here in about 15 hours is really interesting, because people get a chance to experience the full life cycle of a fund, which not naturally is more difficult in real life, simply as a function of time. Just as sort of more on the fun side, working with the next generation. So this is obviously myself, this is one of my colleagues, and this is my 11-year-old summer intern, completely unpaid, co-facilitating and co-teaching at LBS. Also working more internationally. One thing that we are doing quite a bit is around developing VC ecosystems. And again, just like we have startup ecosystems, we mature those into more scale-up ecosystems. And what I look at as the third wave of entrepreneurship is when you have successful startups becoming successful scale-ups, and then many of those founders will eventually sell and exit, and they can now come back, but now they're wearing a founder hat, they're wearing a venture capital or a super angel hat. And we're really seeing that pattern evolve in many places across Europe right now, for example, in Switzerland and in Norway, Denmark, where the ecosystem has been maturing from the startups to the scale-ups, and now into more of the VC, and that's really cool. So here we were in Dubai about a week ago, working with a large number of people from the Dubai ecosystem, and again taking them through various masterclasses, various activities. So that's kind of my day job, and then my other day job, like most people here, is I have about 88 very demanding, very high expecting limited partners. So I am the general partner and chair of Link Capital. So we have been building Link Capital now for several years. We are now on fund number 3. We have a European energy transition focus. So we invest into the green revolution, the green transition, clean tech, climate tech, but we focus on energy technologies. So we are deeply invested into electric mobility, batteries, storage, solar, offshore solar, and we are very happy to take early risk on CapEx projects. And we work very, very closely with the companies. And I think one of the big differentiators in terms of what we try to achieve is really to be a partner driving towards exits and driving towards exit maturity much sooner and much earlier than maybe comparable companies. So right now we have a total portfolio of roughly 75 companies. We have 5 IPOs, 1 M&A, and of course we have a healthy dose of companies that are shutting down or have been shutting down, and that's to be expected. But we have been able to build a European portfolio, build a European network, and now raising a lot of follow-on capital, even just for our fund number 3. So that's kind of my other to move the industry and move the teams that we work with forward. We are invested in Norwegian, Danish, German, Dutch. Some of you may recognize this gentleman right here. So we're also a very small investor alongside Rasmus in Gridio with Conrad. And he did tell me that if I was able to travel to Tallinn today, we would actually be able to meet him in his offices, but we'll save that for another rainy day. Turns out Paris after all. But we really believe in the intersection between energy transition, electric mobility, and the software that powers this. Finally, just as a side note, and I'll kind of come back to this towards the end. For those of you that are interested in kind of digging in more than the time we have today, we're also running several fund manager boot camps, and the next one is in January. That's going to be online, and then we may be able to set up something in Estonia sometime next year in person as well. So, Chris, joining you from Norway, and very happy to get a chance here to work with you all. Rasmus, should we do a on your side, my friend?
Yeah, let's do that. Yeah, so I've been working with Chris for a while now. I think ever since Suddenly's corporate VC arm was being fleshed out, I've been very closely linked with Chris, and just to follow on the fund manager bootcamp. It's actually where we met. I clicked on a random link. Looked like a good ad, I guess, and did a virtual trial run of 4 hours of how the fund manager journey is going to look like. And my favorite part was that he later told me, he didn't tell me this before, that I was a test guinea pig. That was like the second time he had run it online. So highly and heavily recommended. It opens your eyes to things that you don't consider as an early fund manager, and honestly, there are things that you don't know you didn't know, and he absolutely runs it with a great fellow from the States, who has also extensive experience in that. But okay, so a little bit about me. I run Suddenly's innovation arm, which essentially is the corporate VC arm. Running Suddenly Innovation 1, Suddenly Innovation 2, and currently raising our third fund, Suddenly Green Fund 3. In an is that we invest in the exact same verticals with a little different strategy, but the exact same verticals in mobility, energy, material tech, and industry. So exactly in the forefront of the energy system that's fundamentally changing, and what you can build on top of that. So while Chris does a lot of software linked investments and a little bit of capex, we do a lot of capex and a little bit of software linked investments. I believe we're actually co-investors in two companies. One is Gridea, and so the Estonian mobility startup. Another one is actually a UK mobility startup, so Switch. Right, that you actually were on the board of, and got me in. Absolutely amazing in this level. And I don't have as a colorful background as Chris, but I do have a background in carbon finance. So the reason why I'm in the VC world is actually that in the mid 2010s I was one of the ones who wanted to study CO2 and finance at the interlinked of that. So from low carbon projects to how the CO2 carbon markets work, and that just extended fundamentally on my belief that not that something must be done, but something will be done, and I want to be one of the ones who's driving the change. And then I took a little detour from the carbon and the financial world and became a storyteller. I always say that I'm a salesman and a storyteller at heart, because I spent 4 years teaching founders on how to raise funds for deep tech startups, and it's not about the technical level of it, but the founders, they make extremely complicated things and they're really in it. And what you need to realize is that when you're really in something, as in you have deep subject knowledge, it's actually really hard to talk to you, because you don't understand jargon as an outside listener. You don't understand on the angles you're playing with, because the founders themselves live 7 to 15 years down in the future. And we like to say that the VCs can understand their where the founders are coming from, and I do think that we do understand it quite well, but I fundamentally believe that it's because founders have worked really hard to dumb it down dumb it down for us in actually explaining what they want to achieve and what world they believe in. So that's a little bit of an introduction on who I am and where I'm coming from. All right, back to you, Chris.
Thank you. Now, let me ask you a couple of quick questions here, Rasmus. So, for anyone that aspires to set up a CVC, so they work inside a large corporate, what would be your number one advice?
Oh, find someone who's really on the decision-making level in the large corporate, because you're gonna need their backing through and through. I mean, they always say that when you talk to VCs and they have 20, 30, 50 LPs, that seems like a hassle. Try having one LP that can change their mind immediately, or can push you to places that you didn't think that you can go to. So when you're running, when you're trying to establish a CVC, understand what's in it for the corporation, what's in it for the decision makers wanting to make it happen, and also what's in it for you. What do you want out of it? Because the logic of pure, at least when you start in the process of trying to start a CVC, the logic can't be financial returns. Why? Because corporates have their own strategy. They have their own logic on how they're gonna make money, and given that it's gonna the part that you're gonna invest is going to be a small part of the overall value or revenue or profits of the company, then that cannot be the main driver. So it cannot be, look, I want to do this because I think I'm gonna return 3 to 4 times 100 million, right? That's not going to be the case if your balance sheet, in a large corporate is in the hundreds of billions. Honestly, no one's going to even see that. It's a margin of error. So you have to understand why you're doing it and why it makes sense. In Sunley, it's very simple. It was actually set up immediately at founding. So second time founders understood that 95% of the time we're going to build renewable energy assets, solar, wind, storage, but then 5% we're going to invest in the intersection of that, and we're going to invest in people that know what we don't know, that can do what we can't do without our constraints, without the dreaded look, this is our R&D department and it just has a budget to spend. Because what makes startups immensely successful at times is the logic that you have like this fire at the back of your behind, that you need to make something out of it. It's not a 9-to-5 job, and if you can and if you're able to push them, the corporate to go into the corporate VC world, I think that's really important to make them understand it immediately. That if you're gonna bog them down into corporate structures and corporate logic, the investments are never gonna materialize. So push your corporate VC to be as close to a financial VC as possible, and make sure that the decision makers that are first giving you the green light understand that. I think that's number one. Otherwise, you'll spend the next 5 years and, as Chris says, move to a actual VC.
Yeah, no, that happens. One more question, Rasmus. With your experience and the deals that you've been making and the funds you've been raising and everything, you have to be thoughtful of how you answer this. What is the biggest mistake you've done?
Biggest mistake. I think my biggest mistake that I've done is in Fund 1, and it's not a negative mistake, but it's a fundamental mistake, which is to look at companies on an equal footing while they're in different stages in their technology and growth line. You can't compare. This is not comparing apples to apples and oranges to oranges. What you're getting from a company that's 6 years old and having raised tens of millions is not the same as you're gonna get from a company that's raised 500,000 or 1 million. You can't expect the same standard of things, and that really misaligns you with what you're expecting. So I think that's the biggest mistake on a fundamentally strategic level of when you make the investment. I'm sure I missed a lot of really good deals because of that, and I no longer make that mistake. But actually, because you're asking me questions, I actually have like a very fundamental one for you. Like, so why I had this question I asked him 2 years ago, and Chris probably doesn't remember the answer he gave. I kind of do. Why? Like, I mean, you're a VC, you run 3 funds. Why do you teach other VCs? For me, this is, if I talk to, I wouldn't, deal with my competition and teach them how to be better, right? You're competing for the same money, you're the same returns. So why do you do that?
Well, it's a good question, and I'll give you three quick answers. The first answer is I don't believe there's competition amongst VC. Now we can have this argument back and forth all day, but I fundamentally believe that the European ecosystem, the European startup ecosystem, the European tech ecosystem, and beyond just Europe, would be better off if we had more collaboration, more connective tissue, more deal sharing, more co-investment, more tighter follow-on investment. And I think that if we compare ourselves to the US and especially towards California, we have to acknowledge that the networks of people that we compete with, or the networks, the density of those networks gives them. I was saying that I think within the European VC ecosystem, we should really think about this as a really collaborative arena, not a competitive arena. So that's number one. The second is I get bored easily. I like doing new things, and if I get a chance to do some teaching, if I get a chance to do some new programs, that's super interesting in itself. And of course, it builds the network that we have around our funds. So I only see this as an extension of the work that we're doing. And finally, like anyone teaching, when we teach, we get to sharpen and test our own ideas. And we get instant feedback. And when we do something bad, these very capable participants, I don't even want to call them students, they will tell you, or they will tell me at least that, Chris, this sucks. Bad idea, bad explain, bad use of time, and vice versa. So just a couple of weeks ago, I got this message from Cape Town that, hey, Chris, this the one thing that we worked on together around the exit path for a fund, that was enough to move one of the biggest banks in South Africa from, sitting on the fence to actually committing to a PE fund. And it was that one conversation that, helped, nudged. And that was super cool. Very happy for that. So why do I do it? Well, it's complicated, but there are many reasons.
I must say the answer was a little bit short the last time, but exactly the same ballpark. So that's really good. That means you're consistent in what you do.
Fantastic. Well, Rasmus, let's kick off the main session, and everyone, it's really a pleasure to get a chance to do this together with Rasmus, and also together with all of you. So what we're going to do here is we'll transition into the topic, main topic number one of the day. And I just want to see if my screen is able to share. Okay, there we go. Yeah. So let me tell you a quick story here before we progress. So not a lot of people know this, but the first time that we tried to set up a fund, this is about 10 years ago. It was a complete bust. Like really, it wasn't even a failure because we didn't even get anywhere. In our I guess naive Scandinavian approach, we said we have been doing angel investment for quite some time. Now we can set up a fund. Like, how hard can this be? And we went to the local bank, clearly not meeting the right people. We sat down, and something happened during that meeting where they tried to just sell us listed equities. Like, instead of helping us to set up a venture fund, they tried to sell some of the bank's public public equity funds, and it was just like so bad. And then we turned around and we hired a lawyer as the chairman of the board. And then we hired what we believed to be a very capable CEO of a fund. It took us a couple of weeks to realize that none of them actually knew what they were doing, but they spoke and talked like they knew what they were doing. So that didn't work out. And this really annoyed me. And this is now about 8.5 years ago, because I said, how hard can this be? Why don't we have the same access to information and blog posts and textbooks and podcasts and YouTube videos around how to set up venture funds as we do for startups, entrepreneurship, and lean startup in particular? Like, why is there so much material available around the lean startup, for example, while there's very little, if any, material available around the lean fund setup, which we've developed? And that sort of annoying question put me on a bit of a path where I said, I want to learn this, and I want to try to crack open what I call the black box of venture capital. And by saying the black box of venture capital, I mean that a lot of people from the outside have, different understandings, superficial understandings, but very, very, very few people actually understand, both on the GP side, on the LP side, on the ecosystem side, on the founder side. Very, very, very few people actually understand how a fund works and how it needs to work. So, for example, most founders, when they pitch a VC fund, they have no idea what they're talking about with regards to developing a case that is appropriate for a fund in terms of especially around return potential. And as a consequence, a lot of startups, at least here, are chasing VC funding when they're not built for it. They're not set up for it. They should be talking to angels and family offices and CVCs, but raising and working with venture capital is something different. Also, we started seeing a pattern here, and here being Norway / the Nordics, where a lot of people wanted to start setting up funds, but they didn't really have a good place to go. And there was a small community here in Norway, but it was growing, and a lot of people were sort of asking the same questions. And we kept coming back to, well, what does this actually look like? And most people we spoke with, they were lawyers. And they're like, oh my God, they were making this so complicated and so technical. So long story very short, we developed what we call the journey map. And what we're going to do here is we're going to take you through this sort of step by step. And you'll have access to a copy, of course, afterwards. And what we try to do here, and we keep iterating and we keep evolving, so it's not perfect, but I think it's pretty okay. And what we try to do here is that we try to capture the full lifespan, the full life cycle of a fund in one visual framework, in one visual canvas. And we're going to dive in. I'm going to zoom in just a second, and then we'll sort of work through step by step by step. And then Rasmus, please feel free to jump in anywhere, especially if I'm saying something completely off. All right. So, how does most funds get started? So I'm going to zoom in. I think you should be able to see the screen. Okay. So what we found, kind of in our work and our research and teaching, is that there's typically 6 different setups. There may be more, but we haven't seen them, and most of them are quite similar. How does a fund get started? So typically we see that a fund will get started around a market opportunity. For example, artificial intelligence, for example, clean tech, for example, mobility, for example, health tech. But there is a growing market around something. And then, an entrepreneurial GP founder will say, hey, this is interesting. I can set up a thesis and I can pull together a team. And this can happen, over a couple of years. It can happen in a couple of hours. It really depends. Now, once you do that, you kind of come into the investment strategy, and that's where you kind of formalize things and you start shoring it up and it starts shaping up. So, market opportunity investment thesis team is very common, but you can also have investment thesis. For example, I believe there is investment opportunity within the Nordics for artificial intelligence, and with a special focus on generative AI. And then we have to go out and verify, and we have to go out and say, is there a market opportunity? Can I find the deal flow? Can I find the limited partners? Can I find the team that knows anything about this space? So we have to go out and validate and test the market opportunity and then pull together the team, and we go down to the investment strategy. So these are very, very similar, but they're a little bit different in terms of the sequencing. Then we have a team. And this is very often a team that has, especially in the US, it's a team that used to work for a bigger entity. Maybe they worked for a CVC, maybe they worked for a larger fund, maybe they worked for a private equity fund. And that team is now stepping out. And typically maybe 2 or 3 partners, maybe 1 or 2 junior. And the team says, we have an amazing team. What is the market opportunity we're pursuing? What's the thesis? And it leads us into the investment strategy. So you can see the same basic building blocks, but a slightly different sequence. So the next one is what we call the serial entrepreneur. So this is a typical successful entrepreneur, maybe 1, 2, 3 startups behind him or her, have exited, have built up some wealth, have a network, and is now saying, I've been a founder. I've done that several times. I've been successful. Now I'm going to start a fund. So again, we go from the basic entrepreneur, the market opportunity, the thesis, and into the investment strategy. So you can see it's very similar, although in this case it would be a successful founder's fund. Then we have 2 other setups. The first one is what we call a government-backed fund. So this is when you have it as your majority LP. There are many funds like this in the Nordics, and there are many funds, maybe too many funds like this in Europe. Where the government comes in and is a significant LP, and the government either hires a team or brings together the team, validates the investment team, shapes up the strategy. So slightly different, more government backing, more government intervention for good and bad, but it leads into the same starting point, investment strategy. Then we have quite different, and this is what we call the government-led. So with the government-led fund, the government is the sole single LP, and the purpose of the fund changes, and we have a lot of these in the region. So the purpose is now more around the purpose of building the ecosystem, the purpose of creating national economic impact. There is a wider mission, if you will, beyond just the 3x, 4x, 5x return or whatever. And the fund is clearly a national flagship initiative that then goes out and hires a team. And of course, these teams, they tend to be much bigger. This is a really big team. Like the economics of this thing doesn't make sense at all from a traditional VCPE setup, but that's how it is. So what we find is that pretty much every fund in the world follow these journeys or one of these setups. And all of them, of course, lead into the investment strategy. So now it's starting to get interesting. And for some funds, we are now maybe 2 years in, like there's been 2 years of thinking and talking and dreaming, and now it's getting serious. And that happened. First, we have to go out and map out the deal flow. So the deal flow research and mapping. Now, for some funds, they have this naturally, just a function of their network, while other funds are starting pretty cold and they have to go out and do a pretty substantial job of mapping. And I think that that mapping exercise is important and it's relatively accessible, and the information is out there, database is out there, the ecosystem is working pretty well. The thing that needs to happen is, of course, the LP research and mapping. This is a much bigger challenge, especially in this part of the world. Who are the LPs that we want to find? How do we identify them? How do we find them? And how do we start building that relationships with them? And one thing that is just really abundantly clear to me, and now having worked with so many funds around the world, is that this is key. So depending on the quality of your LP research and mapping, it's really defining your success later on. I've seen some funds starting and they have almost nothing here. Like they have, maybe a handful of names. And then I see others that have 3,000 LP prospects in their pipeline. But it's not just a research and mapping, it's also about the conversion rate. Like how many of your LP meetings actually convert into commitment. And that's, I'm going to come back to that, but it's a number that varies hugely between funds. Now, once you've done your investment strategy and once you've done your deal flow mapping and your LP research mapping, you kind of say, okay, let's do this. Let's move forward. Let's leave our day jobs at some big utility company and let's leave our safe consulting jobs. we're going to start a fund. First that everyone faces is the working capital. This is surprisingly where the first number of funds goes to die. A lot of funds do not recognize the upfront cost and how long you may have to go without a salary. And if that isn't clear in advance, you're going to run into cash flow or lack of cash issues. So if you don't have sufficient working capital, you will shut down. And a lot of funds shut down because they misjudged their working capital need. Then we get into the legal setup, and the legal setup is pretty easy. Like, you pay the lawyers enough and they let them do the work, they'll get that done. Then we have the regulatory papers secured. That is usually not a bottleneck. It may take some time, but it's usually pretty okay. There are some cases where these get rejected. There are also cases where they have to be resubmitted and resubmitted and resubmitted. Again, it takes time and it adds cost, but it's not like a death stroke for most funds. Then we have something that's really a question mark, and that's the fundraising strategy. And I love sitting down with emerging fund managers and ask the question, what is your fundraising strategy? And typically they do not have good answers. There's a couple with good answers, but generally they haven't put enough thought through it. And once we start working through some of the canvases and once we start working through some of the exercises, people go, oh my God, we have work to do to prepare our own fundraising. Because I've seen what this looks like when it's done well, and it's incredible. 25 meetings per week, really clear timelines, really solid materials, very quick sort of up or out in your pipeline, and you gain momentum, and it kind of picks up its pace on its own. But regretfully, for most funds, and especially most emerging fund managers, it's on and off. You're doing LP research while you're also trying to close a couple of LPs. So you don't really have a fundraising strategy. It's big weakness, big challenge. Then into the investor deck and data room. And our view is that you need 6 different investor decks and you need a solid data room. It doesn't have to be super complicated, but because very few LPs, except the European Investment Bank, is actually going to spend a lot of time in it, but you do need decent data room. So if you made it this far, and it's a lot of work, there's no doubt there's a lot of work. Now you have your deal flow meeting, deal flow due diligence, and you're preparing your first couple of investments. So that is working with the startups, and for most investors, that's the fun part. That's like, yeah, it's so exciting, and I have all these great deals. But then equally, of course, is what happens here, and this is where it's hard. So now we're back with the LP prospecting and mapping, building those high trust relationships and network. And many first-time fund managers don't really appreciate the importance of the relationship dimension here. Then we have the meetings and the book building, and then we try to get the commitments. This is where the battleground is, right here. Now, what happens most commonly is that most fund managers realize, oh my God, we do not have sufficient pipeline. So we go out and we have lots of meetings and we kind of dry out the pipeline. And now we have to go back again and we have to do more prospecting, which is really annoying because you want to have forward momentum towards your closings, but you actually have to go back to do more top of the funnel research. And a lot of fund managers struggle with that duality. And then you're sort of back in and you have to go back, and then you may have to go back again and you have to go back and go back again. And it's really tiring. And a lot of funds, they die here. So you probably know the statistics, but 3 out of 4 funds, they die because they fail to reach first close, which is super unfortunate. Because I mean, look at all the work they've done. They have done so much work, and then for different reasons, but usually around the LP commit, they're unable to reach the first close, and they die. So I don't have specific statistics for this part of the world, but generally, globally, the rule of thumb is that only 1 out of 4 funds actually make it to first close. And I mean, first close is not even anywhere near success. It is simply moving down the pipe. Now, you get into your first close, and it should be celebrated. So it's like, yeah, we're celebrating our first close. we can now put up the capital call schedule. We can start pulling in some management fee, which is typically the 2% per year over 10 years, although it varies. I know some funds are front loading much more. Some funds have, high and then it's declining. Some funds have a sign-up fee. So there's actually much more freedom for, let's call it, economic innovation around your management fee and your fund economics. But in general terms, first close, capital call schedule, 2% management fee getting pulled off. Now you're in business. Finally, and this is for most funds a couple of years, right? So now you're in business. And then a couple of things. First of all, you do your celebration and you do a little bit of PR. But what's actually happening is that your required work explodes. You go from having a relatively easy job to suddenly having a much more complicated job. And I think many people on this call have been through this exact journey. Now you're doing your first investments and you're closing out the deals that you had pending. You're now building your investment portfolio. And of course, depending on how fast you can go, you can have 3 companies, or you can have 20 companies kind of coming off that first close. But you also have to go back and do a lot more LP meetings and book building, get the LP commits, and then you may get into your second, third, fourth, or fifth close before you eventually get into the final close. One observation that I have from working around the world is that one of the key challenges that many funds face is that they have too high first close. So the first close may be at 50, 60, 70, 75, 80% of the total fund commit. So if you're doing, for example, a 100 million fund, you may have 65, 70 million for your first close, which obviously is a high target to reach. My general recommendation, if we can make the economics work, is to do the first close as low as humanly possible. So if you're doing a 100 million fund, you can have a 5 million first close, for example, because the goal is speed up the process, get going, make those first investments, show your strategy in action, and get progress, not get stuck on fundraising. So a lot of the funds that I see that struggle because they've set the bar too high for their first close. Rasmus, Can I ask you a question? So what do you see in sort of your part of the world and your experiences around what should that first close look like?
Yeah, so that's actually a really good point. I actually want to jump in anyways. So the problem with this is that it depends on where you're getting your biggest ticket capital in, right? Your biggest ticket capital also has some regulation or things linked to it that you need to achieve. So, for example, if you're doing a government-backed backed strategy, whether it's team first, investment thesis, and then government money, you're by default are at a higher level at the initial close. But what's really important is that all LPs talk. So and what I see a lot happening, especially with like the first. The merger managers and the first timers, or even maybe second timers doing a slightly bigger fund, is that they reduce the amount that you want from each LP. But generally speaking, obviously depending on if your LP is an angel or it's a bank or it's a corporate, unless it's an angel, the actual number doesn't matter. But what matters is that if you lower it for one, you're lowering it for everyone. Because all LPs talk, and that's why it's really important to get to the level where your first close is people you already know, people you've already worked with on deals in your past life. Maybe you're the owner of the company that you were leading was very happy with you and really sad that you left after 5-6 years of building wealth for them, and then reaching out to them is extremely important, because if you're backtracking more than a few times when it comes to the fundraising cycle, you'll get demotivated and the market gets demotivated because there are things that can happen regarding your market opportunity and investment thesis. If you take 3 years to get to a close, your thesis might not hold up anymore. And the second is that if you're there constantly and you're constantly telling them that, look, this is it's gonna be a big thing. We're gonna close it. We're gonna do it, and it doesn't happen. Everyone just loses interest because you're competing with everyone else for roughly the same amount of capital. But like you greatly said, then the fund economics is also an important aspect of your first close, because you don't want to be in a place where you hit your first close and your fund economics don't work, and then your second close delays, and everyone knows that. Then you're shutting down with liability, not just shutting down. But no, it's 100% of a thing, and for every single emerging manager, I always say it's kind of like interviewing for a job. Know your minimum that you will accept from this type of an LP. There's no point to take in an LP that has a lot of regulatory issues related to them that you have to work with, and then take 200,000 from them. It just doesn't make economic sense, because then everyone else who has the same level of capability and requirements is going to give you the exact same ticket. So I think that's really important to understand, that sometimes it's also okay to not accept money if it doesn't align with what you're trying to achieve. Because otherwise you'll have a great portfolio that you cannot invest in, and then the other VCs will look at you and say, thank you very much.
No, indeed, and as you were saying this, I ran a masterclass in Asia about a week ago, and we worked on what does your funds setup look like over 3 funds, and that's not something that we've touched on here yet, but it basically means that, let's say that you're doing a 50 million fund today, and then you should already have the outline ready for your fund number 2, which could be 50, 100, 150, and then you should also have the outline ready for your fund number 3, which typically could be a 250 fund. So as you're speaking with all of these LPs, you may realize that this LP needs to put in a large ticket, doesn't fit in our fund number 1, but it's a perfect anchor for fund number 2 or even fund number 3. So you're working to kind of put the different LPs in the different buckets for the different funds at the same time.
Yeah, I think people fundamentally underestimate on what it takes for example, a large multinational to do work related to investing in a fund, and if you know them well, and they're happy to share, they'll let you know upfront that their fixed costs are too high to give a ticket too low. But then they also have a cap on how much percentage of the fund can they take. So I think that's really important, and hopefully for people it comes through in the LP research and mapping. But sometimes you also have to go and circle back and fill in the gaps of what went wrong, and it might not be anything to do with your fund specifically. It might be just with the technical constraints. And people underestimate that. It's exactly the same logic as you previously mentioned with startups, that you pitch a great business case, but it's not a VC case. It's an angel or family office case, or maybe a corporate VC case. And it has no bearing on do we think that your business is going to work or not. The success metric is just very different.
Yeah. No, you're absolutely right. So as we're working, sort of moving this, we're now getting into, and again, like Rasmus said, finding the different LPs that actually fit, finding the different LPs that can actually commit, and getting kind of the final LP commitments into your second, and in this case, final close. Now, so far, I'm going to zoom out here. So far, we have now spent a significant amount of time on what we call setting the fund up. You have started investments and you have started investing, but in reality, all you've done is to set up the fund, find the LP, and build the pipeline. Now, here's a question, Rasmus, if I can ask you. On average, how long do you think this takes from the, let's call it the ID stage, until that's final close? And of course, there's still a lot of work to be done, but from idea to final close, how long do you think that typically takes?
I mean, minimum 2 years, and it depends on how much did you have to work to get to the idea. Because if you're already an angel investor and you co-invested with a lot of angels, it can be quicker. But if you're the normal, I have a good idea. I left my great consulting gig, or I left my or I left a fund where I was on principal or associate, but I've not made direct investments myself, and I got then it can take much longer. So people think that once you get your first tickets in, you think it's gonna go really quickly, but it's not. I mean, even the legal paperwork takes a while. Let alone fleshing out your proper pipeline. I mean, I would always say that that if possible, don't do it in a way where you have where you drag out your your funds like first close. Do a really small first fund and actually use that as the second fund. Your like backer, because your first one can be 1 million, 2 million, 3 million. It's okay to show what you can do, and then go to the one where as Chris liked to say, I remember it 2 years ago. Anything below 20 million, that means you're working for free, and that's the logic. So you rather have a small fund and build it on that.
No, you're absolutely right. And I think one of the best examples here in this part of the world is unconventional ventures with the sort of the gender lens investment case. And I believe they started with a 250,000 fund number one. And then they went into, I believe it was around 2 to 5 million for fund number two. And now they have a very impressive LP lineup for their fund number three, which is around the 30 to 40 million range. So it is absolutely possible, and it's even advisable to start small and then build multiple funds very quickly. I know some of the accelerators in this part of the world, they do SPV vehicles. So they set up a dedicated SPV for each of their accelerator programs. They raise money for that program instead of doing the larger funds. One thing that's interesting here before you progress is, in terms of what I've seen around the world, the longest case, like working from the ID stage and all the way through to the final close, has so far been 7 years. So there's a couple of examples. Most of them are in Africa, East Africa, where they have had, I want to say, the incredible persistency to not giving up, but continue to work through challenge after challenge after challenge. It's team issue, it's regulatory issues, it's working capital issues, it's access to the LPs, it's closing the LPs. And some of these big LPs, especially as DFIs, they can take easily about 2 years to commit. So 7 years is the longest. And then in terms of the shortest, I'm actually looking at several funds, very small funds, but they're able to kind of sprint through this entire journey in a couple of months. They may have been thinking about it for a while. And also our fund number two for Link, that was a 5 million fund. And we basically set it up in a couple of months, and we did the fundraising more or less in 6 to 8 weeks. So it is possible to do faster funds. But the reality, like you said, is that it can take a couple of years. Now so far, we have reached what we call the setting up stage. And of course, then we can get into the fun part, which is really around the investments. And this is where most people, at least in the beginning, think this is the job. But let's be honest, the job is a lot more than just making the investments. So now you're starting to really deploy the capital that you have. You may have a portfolio strategy, like maybe you're running an accelerator programs, maybe you have different development programs. You may have different types of active ownerships. You may have pre-commitments on your follow-on. You may work with the founders to raise more follow-on money. And of course, your portfolio now starts taking on a life of its own. Statistically, you will start writing off companies quite quickly. So there's a phrase called lemons ripe early, which translates into the weakest companies will not be able to do any follow-on rounds. And even after your seed or seed extension or pre-A round, they'll start closing down. So you now start writing down, and most funds follow the infamous J curve, where you're actually quite negative for a while before you start coming back up again. And you will have shutdowns, you will have bankruptcies, and you will have write-offs. And we also had this, quite quickly in some of our investments, where even just in a few months, we see that, the team is not able to hit the milestones, and you can just sense that we're now starting to go downhill and part of that game. But you can also have these fast-moving investments where teams are just, they're crushing their KPIs, and they're getting significant inbound investor interest. And they're able to raise large follow-on rounds, and your multiple on investment capital just starts going through the roof. And suddenly you're like, hey, we have this one company where we have 8x multiple in just 6 or 12 months. And it's amazing. What happened? Well, I guess it's called luck. Then you may get into, typically your A and your B. There's no liquidation, there's no distribution, but your multiples look good and your portfolio hopefully looks good. And then increasingly your portfolio is now maturing. You're doing larger. I mean, this is typically a C or a D round. Maybe we're an E or a F rounds, like very large late stage. And your total value over paid in really starts going up. So you have some that are going downhill, and then you have some that are really starting to fly. And you start looking at some of these high-flying exits. Maybe it's a strong IPO. I mean, the IPO market will be coming back. Maybe there's some strong M&As. Maybe there's some private equity, and you're chasing maybe secondaries. And you really start thinking about how do we generate distribution back. And I think this is where a lot of funds have room to improve. How do we understand the difference between multiple to distributions? So you're now working through your exits and your exit strategy. And I just got to flag this, that the number one weakness that I see in data rooms all around the world is, what's your exit strategy? Now, of course, this will vary whether it's a private equity fund or a pre-seed fund, but the large majority of LPs that we work with, they're all asking for the same thing. What does your exit strategy look like? So even if you're investing pre-seed Nordic tech, we believe, and a lot of the LPs believe, that you should have a dedicated chapter, you should have a dedicated focus, you should have a dedicated strategy for getting rid of the companies that you have so dearly invested in. And that's difficult. And it's especially difficult if, the timelines don't align with the founders. The founders have a passion for keeping control of the company. So there's a lot of things that I believe we can do within the ecosystem to prepare that exit strategy. Do all these things well, good things will happen. Just want to mention this. While also running the sexy, the investments and the follow-ons and the why we invested and the portfolio flashing, there's a mountain of back office. And I think that most first-time fund managers, they really, really fail to understand this and appreciate it until they're actually in the midst of it. Media positioning, marketing, communication, working with different media outlets and media channels, podcast, video content. There's a lot of things that can be done around the marketing and the communication, both for your funds, towards your LP, and for your portfolio companies. Then we have the LP reporting, which is fairly standard, but still need to get done well. LP engagement, relationships, workshops, events, summits. Like, how are you going to work with your LPs once they have committed some money? Fund admin, it's always a much bigger issue than most people think. And the economics, again, can really be challenging. Fund accounting, taxes, going to love those. Auditors want to come in and discuss the valuation principles that you've applied. A lot of people that, again, don't really understand venture capital funds are mixing in with the accounting and taxes. Then we have Article 8 or 9, ESG impact reporting. And then, of course, you may be hiring and expanding your team. So there's a lot of things that you got to do to sort of keep the company running while you're also keeping your portfolios running. Now, as we move towards the end here, we get into, where it really matters, which is, what is your fund performance? And here we see a couple of different things. So first of all, that the reality is that there will always be funds that collapse. It is typically down to teams that break down, and then it may be a couple of really bad investments that blew up. But there is a significant team risk with all emerging fund managers, and that may actually lead to barely any returns back to LPs. And you may be looking at something between the 0x to 0.9x DPI, and desperately trying to extend the life of the fund. Like, we have a good portfolio, we just need more time to realize some value. It's not pretty, but it happens. Then we have, a pretty significant amount of funds that will be underperforming the market. And this underperformance is important to understand because it is a reality for most LPs that they will be investing in funds that fail to meet market returns. And again, it's very often because they're not able to create liquidity, they're not able to create it. Then we have the market returns. So, the range between maybe 10% and 30% is a big range. That will lead to what we call returning some money back to LPs. The statistic is pretty challenging, but if you're able to deliver 1x, you're doing okay, but obviously not great. You basically give the money back with no premium on top. 2x, 3x, 4x DPI is even very challenging. And I don't have good data on the actual distribution for Nordic funds. That's something I'm trying to get my hand on. But we do have the outliers and the outperformers. So in every market, in every vintage, there are examples of really, really successful and strong funds where they have what we call a couple of unicorns or a dragon, or they may be having multiple dragons and multiple unicorns and maybe a couple of decacorns in there. And they may be looking at something like 40 to 50 or higher IRR on the fund. And it leads to significant distribution back to LPs.
Chris, so we have two good questions. I was thinking of interrupting, or both of you can answer. So first, what are the metrics that we should prepare the most for the LPs for the fundraising when you're still a new or an emerging GP? And second question, you mentioned that the first closing amount should be as low as possible, like 5 million for first closing for the 100 million fund. How long would be an ideal time frame between the first closing and the final closing?
Yeah. Super question, and I'm very glad you interrupted. It's a perfect timing. I'm just going to zoom in, and then I'm going to answer those two questions, kind of placing them onto the map. So if we look sort of the total picture here, what we have is really a full lifespan of a fund. And what we like to say is that this part is the front end, and then this part, after you have made all your investments, is the back end. And most fund managers focus very well on the front end. Like, we're going to raise a fund, we have a thesis, we have a strategy, we have a team, we're going to build a portfolio, we make the investments, and now we have our investments. And then there's a lot of room to improve on the back end. I think that's really important. Now, in terms of the question, let's do the second question first. So how long should you plan between your different closes? So I can zoom in here, add a couple of points. So one thing that I mentioned briefly is what we call the conversion rate. And I think that, if there's one secret sauce in this business, it is the ability to generate exits, and it's the ability to increase your conversion rate. And conversion rate means out of the LP meetings you have, how many say yes? And we split it in two buckets. So the first bucket is, these are LPs that you know and they trust you. So if you have 100 meetings, how many will say yes? And they already have a relationship with you. And the best in class, like the really best practices that we see, the best fund managers, they have a conversion rate with their existing relationships of about 50 to 60%. So they have 100 meeting and 60 people will say yes. That's really, really, really strong. And then we have the cold relationships. And that can be anywhere from 2 or 3% towards 0.2%, which is obviously very, very low. And that's important because that is a function of the time. So from your first close to your final close, you can have multiple closes. And I would generally say that you should try to complete that full session in less than 3 years. Ideally, I'd like to see it done in a year and a half. And perfectly, I'd like to see it in less than a year. So if you can do your first close in January, it would be incredible if you could do maybe your second close in June and then your final close in December. So that's 1 year. But it is more common to see like a year and a half to 3 years for that closing.
Just to add on top of that, I think it's really important to understand your investment period as well. I mean, if your first close is really low, and your investment period is 5 years, and your next closes or your final close comes in like 3 years down the line, you generally have very little time to actually invest anymore. So that means that you would have had to probably shift strategy where you're allocating for follow-ons significantly more, or you're significantly lacking in portfolio construction. So it has like a practical implications as well. Why it makes sense to do it in year and a half, because then it aligns really well in terms of capital deployed. But if it's 3 years down the line, let's put it this way, you'll be spraying a lot, or talking to all your LPs that let's please extend the investment period, because if you've done 10 investments and you want to do 50 and you have 2 years to go, like that looks like a rough patch.
No, you're absolutely right, and I think, Kadri, I mean, a lot of people understand these things, but when we try to put them together and put them together on the timeline, it's actually really tough. But for your first question, maybe could you repeat the first question? I just want to make sure that I get it perfectly correct.
Sure. So what are the metrics that we should prepare the most for the LPs for the fundraising when we're still new or emerging GP?
Yeah.
So what do the LPs look at when you don't have much to show?
So what you're really looking for is what we call the LP thesis fit, which means you gotta find the right LPs for your fund. And we typically work with 5 levels, so level 1, 2, 3, 4, 5, and we have 18 different categories of LPs. And if you raise from your level 1 and 2, it's basically done on trust. Like, they know you, they trust you. They may not even look at the pitch deck, and they wouldn't even care about the metrics, and they couldn't care less about the terms, and they're not even going to read your LPA because they trust you. And they'll say, "Oh, you're raising a fund, fantastic, I'm in." And I mean, that's it. It's the easiest thing in the world. Now, if you go towards the level 4 or 5, which is like DFIs, big pension funds, maybe sovereign wealth funds, like they're really, really, really big, you stand almost no chance as an emerging manager. Like, they will kill you on formalities. They'll kill you on track record or lack of track record. They'll kill you on a lot of things that makes life really, really unpleasant. And it's not because they're mean, but it's because they have seen and they know what it takes. So what are the metrics you should focus on? Well, ideally, if you have a track record, even as an angel, that is your focus number one. And for example, one of the Norwegian funds called Sondo Capital, they set up a first-time fund. So 2 guys, first-time fund. But they had several very, very strong angel investments behind them personally. And they had one unicorn, Dune Analytics. And they took all of their angel investments into the fund as part of their GP commit. As a consequence, the fund had one, and they bring them in at cost, and then the fund gets the benefit of the value development. So as a consequence, Sondo Capital actually had a successful unicorn in the portfolio before they had raised a single dime from any LPs. So obviously that helps with the story. So the metrics you want to focus on is really your track record. If you have a lack of track record, you should focus on your access to deal. So we have founder relationships. We see the best deal. You should focus on some examples of how you're able to pick the best deals and access the best deals. And then I think for a lot of fund and a lot of decision makers, it really comes down to what is unique. And I think in the US market, it's much more understood that you're competing against other fund managers with similar teams, similar thesis, similar strategy. I think in the Nordics, we haven't had that as much, but it's starting to happen. So you have to understand your competitive landscape. Like, what are the other climate funds? What are the other AI funds? What are the other fintech funds? And how are you different? And why are you better? So there's a lot of things to take in for emerging fund managers, but it comes down to relationships, It comes down to finding the right LPs, and many LPs don't care about anything; they just trust you. It's about shaping a story around the strengths that you have, which may or may not be numbers and previous investments. And then it comes down to basically building the relationships and communicating how you're different and why they should invest. So that's the short version.
Great. Thanks.
I mean, I would just like to add that if you're an emerging fund manager, the best thing you can do is to build your own, to bring your own angel portfolio investments into the fund at cost. I fundamentally, because everyone likes getting something for nothing, in that sense. Because you've already done the investments, they're older, and everything like that. Then everyone who marks up, you come in and you already have a fund markup. That I think is by far the key, assuming you have nothing else to show from previous funds or working with different funds or extremely close networks. Because if you've made some bets, even when they were small, like that's okay. It truly shows that you are aligned with the fund itself. And you're not using it just as, look, I have past metrics, because we all know investing, historical metrics don't lead to future, future data points. It's a direct correlation. But if you're already bringing them in, then it adds so much value.
Great.
So maybe I can add some, medium positive statistics to this picture. So this is pretty much what journey looks like. And this normally take about 10 extension 12, maybe extension 13 years plus. So in reality, this is like a 15-year of your life that you're doing this. And then if you're medium successful or even relatively successful, you get about halfway, and then you're going to start your second fund, and then you're going to start your third fund. So once you commit to this, you're really looking at about 20 years, maybe 22 years of work before you can call yourself like done. Which by being done, you're either very unsuccessful and you sort of slinker off stage, or you have been able to build an investment company with multiple funds. But the statistics is the following. So only 1 out of 4 funds make it to first close. So that's 3 out of 4 that kind of fall by the wayside in the beginning here. And mostly down to working capital and lack of LP commit. And then move through the stages, roughly 1 out of 10, 1 out of 20, 1 out of 5, 1 out of 10 funds are able to reach their financial targets, which is typically a 3x DPI, which means that the large majority of funds do not get off the ground. The ones that do get off the ground mostly fail to reach their financial targets. Many of them do okay-ish, but below what they were targeting. And then it's even fewer funds that actually get into carry, where the limited partners, with the general partners, with the founders, can start getting paid from the carried interest of the fund. So it's a really hard business from a success point of view. But I want to tell. We'll see if people know this gentleman. So I'm going to frame this as a question. Rasmus, maybe I can ask you. So let's ask it. If we ask anyone, and I'm going to be asking you, Rasmus, do you know who this gentleman is?
Of course, I know Chris Saka.
That is so not obvious because I use this question a lot, and most like if you put up like the best football player in the world, people know him. If you put up Bill Gates, people know him. But you put up Chris Saka, which probably has the single best performing fund anywhere in the world, anytime. Most people don't recognize him, which is strange. So, Rasmus, maybe you could elaborate. Who is Chris Saka?
So he's an investor that started investing into tech. So one of the early investors in Twitter, for example, and now he runs lower capital and lower carbon VC funds. So going all in clean tech. But if I'm not mistaken, he did start exactly the way I said, which is you you work in a growth company, you start doing angel investments, you flip those angel investments into a fund, you raise a fund, and you go from that. Today, when he's raising a fund, I think in the last one he doesn't even have an LP anymore, or maybe it's one. It's quite remarkable on his track record and how he's built it, and he's built it on the way of ignoring all hype trends. It's actually it's a legend in the VC world.
He is a legend in the VC world, and I think that more people should at a minimum be familiar with the name and his work. So again, this is Chris. He used to work for Google, and he worked in Silicon Valley Tech, and he left. And he set up a fund called Lowercase Capital, and then later he built out Lower Carbon Capital. But Lowercase Capital number one was a small fund. It was about $8 million, so it's not a big fund. By most standards here in the Nordics, it would be called a micro fund or even a nano fund, and it would be labeled as you can't succeed with such a small fund. But if you invest like he did, early ticket in Uber, early ticket in Twitter, early ticket in Instagram, and more. Rasmus, do you want to guess? Maybe you know this, but do you want to guess what was the multiple that Chris had on his first fund with those investments?
See, I don't actually know that, but I'm guessing it's a little north of 60.
Well, see, by most, so if we do the math here for everyone, most funds today go to market and say we're going to do a 3x, and statistically, most funds do not meet that threshold. They do something between 0.7 and 1.8 roughly, which is not great. If you're able to do a 3x on the fund, you are amazing. Like, you really stand out. If you are like Gary Tan with their first fund, they did a 60x on the fund. There's a couple of funds, all US funds, that have done between 90x and 100x. But some lucky, and there's you have to be good, and you also have to be lucky. And Chris Sacca did a 250x distributed back to LPs on that fund. And I mean, that is the equivalent of a soccer player scoring 100 games in a match. Like, it is so ridiculously good that it doesn't even make sense. And the reason why I want to show this is because I think a lot of funds focus on the challenges of setting up. Like, it is hard to build and raise a fund. It's doable, but it's hard. But what you really want to talk about is how do we replicate what Chris Sacca did, or at least how do we deliver that outside performance, and what does that look like? And once you build that fund model and you run the numbers, you realize it's actually really hard, and you have to be both good at picking, you have to be good at doubling down on the best ones, and you have to be able to kind of get returns that allows you, the front page of Forbes, 250x return. I would love for us in the Nordics to get a couple of funds that just strike something along the same lines, whether it's 40x or 50x or 60x or 100x. But if we could get something and get some data points around it and get some visibility around it, that it's actually possible for institutional LPs to commit into funds in the Nordics and then return these kind of crazy outliers, that would make me very happy, and I think that would make a lot of both LP, GPs, startup founders, and more very happy. So, Rasmus, what are you doing right now to kind of work towards your version of this?
I was about to say that the most important part that everyone always glances over with Chris Sacca is that he actively worked towards the exits as well. Because it's not about the fund markups, because everything can happen. We filed for bankruptcy while the markups were immense at one point. The point is that when the goal is when you enter, when you follow, but you also need to know when you exit. I mean, sometimes it's easier, sometimes it's harder, but it's very, very key. And in less mature markets, for example, like in Estonia. there's much less emphasis put on thinking about exits, and much more emphasis on put on multiples. I have this saying with one of the other partners in Sunday Future Ventures. He used to be a private equity guy, and then he was a CFO of a growth company, and he said, he always says it really well. Nothing matters until cash is returned. And that's and I fundamentally think that that's key, and I think that it matters to the level where as a VC you understand that very few of your investments are going to strike gold, and then the question is, when do you sell? Because if you sell too late, your multiples might decrease, or you might not even be able to sell anymore. Because it doesn't matter. Let's say they hit a little bit of a bump in the road, had to raise a lot of capital at a lower valuation, which was happening in 2022 and 23 after the boom. Then this is your whole 15 years of work can be just wiped away with something with something that at a glance appears out of your control, but actually was deeply in your control. And I think that's actually one of the good pivot points onto the next topic that we wanted to cover, on why you should work with corporate VC arms, and everything in between. It's because the reasoning behind it. So just like Chris asked me, it's like, what am I doing to work on the exits to get to Chris Saka's level? Is the fact that almost immediately, almost as soon as you enter a company, you have to have not only a growth line on what you want to do, but also a plan on what will you do when X, Y, or Z happens, right? And I think that's why I think corporate VC arms are a really good partner to pure financial VC investors in that setting, on the fundamental level. Why? Because they show you quite quickly on what they're investing at, where and how much. So your success metrics are what they are. Are they an exit to a corporate? And roughly what level deals they do, or you are in the belief that you're going to write this out to a self-sustaining business where it IPOs, right? And that will fundamentally drive your decision making on your follow-on rounds, and how you will work with the founders, the management team, in your portfolio. But for that, it's really important for you to understand that corporate VCs are different. Just like VCs are different, corporate VCs are different. And if you ever do the fund manager, then Chris has a great image for it, where you're asked to create your own corporate VC arm and actually to think about this. So the logic behind it is who makes who made the first decision on to start the corporate VC arm. It cannot almost ever, unless you take in outside investments like Sunny has into the direct corporate VC arm, it can never be a purely financial driven decision making, which automatically makes every single corporate VC more conservative in nature than a normal VC. Why? Because your whole decision making aspect gets much more difficult if you have one single LP, and you show up in 4 years down the line, and you show the J curve as very negative at the start, right? Just like Chris mentioned before, and then you need to understand on why they make investments and what they want to get out of it. Is the corporate VC arm pure deal flow? I give a little bit of money, and a little bit of money can be tens of millions, or even 50, or even more, because I want to actually boost my M&A arm, because eventually I want to buy what you're selling. I don't want to I don't want to be an investor and then sell it to someone else. So that's one question you must immediately ask yourself: is this a strategic play to them? If it's a strategic play to them, you'll know, at least in Europe, that the exit value is going to be 50 million and below. And if at investment time, when you make the investment, it can be completely fine to enter a company at pre-seed level and exit at 50 million. It can be a dragon, aka a fund returner, and that completely aligns with what you're trying to achieve. But if you're playing this game and your fund size is 200 million, then obviously we're not hitting that level. Then the second is what you want out of the corporate VC relationship. Is this a gateway for you to get into closer in line with a corporate management team? For example, because you actually see them as your biggest customer or one of your biggest customers, and boost value in that way. So it can be an independent business, but you know that the only way they'll actually buy from you in a significant way is if they've invested in you. There's this Americans have a really good. Most of corporate VC in America has a really good saying for this. They have two principles. One principle is we only invest if you can be the number one or number two, and if you're number two, we'll buy you. If you're number one, then it's great. We'll reap the financial returns. And the second, we'll actually invest in you because we want to make sure that the main line of business in the corporate wants to work with you. And if there's no financial incentive to work with you, at least on the fund level or on the partner level, then why would I spend my time on this? Especially in the early stages, where you're trying to boost massive value in the startup that you invested in. So they call it as it's kind of on the level of, it's like in poker where you make a pre-flop bet, as in like you pay to see cards and you don't want everyone to see the cards. On that level, and lastly, because as I mentioned at the start, most corporate VCs by definition are actually evergreen, and when they're evergreen, that means that they work on a different time scale than you do. So let's say that you didn't hit look, we knock it out of our park. We're gonna, IPO at a $500 million or 10 billion valuation, maybe because that's not the viable company. The company creates a feature for other companies. Let's put it this way. That's most of fintech, right? And you realize that you need to lock in, potential exit partners 4 years before they need to materialize. And because their CVC arms are, like I said, evergreen, it makes sense for them to eventually become your exit partner at a really good exit for the fund, because they're not looking at this in a level of look, I need this to return in 7 years. I'm completely fine with returning in 15, or when we go to the Japanese CVCs who I personally enjoy working with the 50-year timeline. Your math and your decision making fundamentally changes. But if you have a 50-year timeline, then you also need to realize that the exit decision making takes 3 to 4 years. so working with them before they are investors in your portfolio companies is extremely important, because it boils down to the exact same logic, which is trust. Do I trust that you're selling me something that I want, and something that I believe in, and something that I understand, or are you trying to just parcel off your lemons in this kind of a setting? And that's why it's very, very important for every single fund manager, especially emerging fund managers, but every single fund manager, to deeply understand why you're engaging with corporates, how you're going to engage with corporates, and what you want out of them. The biggest funds in the world, so the ones that have assets under management in the billions, don't want to work with corporate VCs. Why? Because they are not an exit route for them. It doesn't make financial sense. I'd rather just on a very bluntly write off an investment than sell, because it takes so much effort. But it doesn't mean that they don't engage with them on what the corporates look like, where the world is going to, what are they going to be buying if it's part of their supply chain or part of their or a feature in part of their core business, and the corporate VC arm is a very good indication of that, because they are almost never generalist. They almost always invest in verticals that they struggle with today, or they think that they will struggle with in the near future, 5, 6, 7 years down the line. So in that setting, you have a really good idea of where the market and the world is heading towards. Because as much as we like to think that most things happen, at random, they are actually driven by market makers at the start, and then you'll have some arbitrage opportunities. So in that setting, it's extremely important to understand what your corporate does, how they work, and why do they engage in the VC world, and why will they make people like Chris quite immediately.
Well, let me pick up on that. And when we were invited and when Kadri invited us, it was a kind of question of well, how can venture capital funds and how can VC funds and how can emerging funds work with CVCs? And I think we can zoom in on that a little bit. And I've probably seen the insides of somewhere between like 80 or 120 CVC units. Some of them very big, some of them very small, some of them just idea stage, but like roughly that number. And I think that we can segment them in 3 buckets. Bucket number 1 are the pros. So, for example, in Norway, that would be Equinor Ventures and it would be Statkraft Ventures. These are exceptionally talented CVC setups and very, very talented people, and they know exactly what they're doing. So if you want to collaborate with these pros, I mean, you have to show up ready to work, and you have to know what you're doing. I mean, they'll dress you down in seconds if you don't know what you're talking about. The second category, I call them the learners, and the learners are probably in some stage of setting up and developing, setting up and growing, but they really want to be successful, and they've put in the time to build a good, maybe even great CVC. I see a lot of utilities in that bucket. I see some tech companies. I see some banks, and they're really trying. And if you partner with them, you're basically going on a learning journey together. And they want to learn, and they want to grow, and they want to develop, and they want to do better. And they have internal challenges like you wouldn't believe. And they may have some team deficits or lacking some team expertise, but that can be solved. But they're trying and they're developing. And then you have the last bucket. And I want to be careful what I call them here, but let's call them the not very likely to succeed CVCs. And the reason is they don't have what it takes. They don't have the internal alignment. They don't have the internal mandate. They don't have the all the kind of the multitude of people that need to be involved and working in line. They may not have the expertise, and if they have the expertise, it's probably just a single person, and this single person has to then fight the bureaucracy internally, where he or she will burn out before we get any deals done. So for many reasons, and most of them having to do with setup and mandate, they're not very likely to succeed. And you can waste you can waste years trying to engage with them. But Rasmus, I'm gonna try to overlay some of the things that you said onto the fun journey map. We're gonna try. We've never done this, but obviously we've been thinking deeply about this. So I'm gonna zoom in on the Maro, and we can see if we can bring that up on the shared screen. So the question was, how can a venture fund work with CVCs and corporate venture units? I'm going to use this in blue here. So I think the first step is when you are developing your investment strategy, I think it's really important to be familiar with the ecosystem, to know your industry landscape. So for example, in climate tech and energy tech, you want to make sure that you understand who are the utilities with CVCs globally, who are the oil and gas companies, energy companies with CVCs, and most of them have. It kind of comes and goes a little bit, but most of them have. And you want to make sure that you have them on your radar and you have them in your relationships. Then once you get it, I think there's an amazing opportunity to have LPs both as your limited partners It is not easy to get a corporate to come in as and get a corporate venture team to come in as a limited partner in a fund, but it is possible. It is being done. Again, I'll just take the Norwegian Equinor as an example, and they have right now probably about 14 funds in the portfolio. Half of those funds are international focus, and the other half is a very specialized focus. But they have funds in the portfolio, and they have that in that sort of portfolio construction mix. But you can also work with corporates and CVCs in terms of deal flow. They are unlikely to share, but you can share. So you can work with them and bring them in, invite them in on deals. So if you do this well, you will be really, I'm going to call it intimately connected, both on the LP conversation and also on the deal flow conversation. But it's interesting as you progress. So once you start making your investments, that's where I think a lot of your CVC potential comes to life. So let's say that you have built a portfolio now of maybe 20 companies. And then I think immediately in terms of customer acquisition, in terms of strategic partnerships, in terms of follow-on investments, I think corporates and CVC teams should absolutely be on your radar. For example, if you're building a fintech fund, you have to have, I really emphasize, you have to have deep knowledge of all the corporate venture capital teams within the fintech space globally. Like that is a big part of your network, and it has to be a big part of the kind of the later stage investors that you work with. Equally, within the energy transition and climate tech, you really need to know the key corporate venture teams within the mobility space, within the energy storage space, within the energy generation space, and these are out there. And I would suggest that probably I'm going to ballpark this a little bit, but probably within the climate tech space, there's at least 300, maybe 350 CVC teams that you should have on your radar. I mean, that's a full-time job right there. But these CVCs can come in for your later rounds. And if you look at, for example, Northvolt, the Swedish battery maker, and you see the incredible importance they have from working with Siemens, working with Volkswagen, working with many of these large European corporates, where they are both a customer and off-taker, and they're also an investor through their CVC arms. But I think where the CVCs really can come into play, and I know this is really difficult, but it's part of your job, part of the mission that you signed up for, is on the exit sides of the equation. So we have been involved personally in multiple transactions where we have a startup, we make an investment, we get a corporate venture team to come in as a follow-on investor, and they may take a big chunk, and they may have some special terms. But that's okay, because you have already clarified that we're actually working towards a potential exit to that corporate mothership. But that exit is not going to happen through the CVC team. It is going to happen through the business development M&A team. So you have to understand that working with the let's just say Siemens, for example, working through the Siemens corporate venture team, you will have to partner with them, and you will have to navigate all of those internal relationships that allows you to get into the business development, M&A, and acquisition team, where they may or may not be able to acquire the startup from your portfolios. So when I look at this, I think about most funds have significant opportunity, like really, really significant opportunity to work with corporate venture capital teams throughout the journey. In the beginning, it's all about network and ecosystem. Then you get into the discussions around sharing deal flow and getting some LP commitments. And I can say for our fund number 3, we expect to have several corporate venture capital teams as our LPs when we do the final close next year. And then the most important part of how to really engage with the corporate venture team successfully is around the co-investments or the follow-on investments. And that means that you should be building a pretty active network of follow-on investors within the corporate space. And you need to know what they look for. You need to know their strategies. You need to know their decision-making processes. You need to know how they write their memos. And if you really get on the inside of that information, you should be able to prepare materials, briefs, even memos that will just fit into their workflow to make life easier for them. And then finally, if you do this well, really cheering for you, you also have towards the exit side of that equation. So you can choose to work, I'm going to say, by neglecting CVCs, but I think it's very beneficial to be really respectful and intelligent about how you combine and connect with CVCs. How does that resonate, Rasmus? Is there anything do you think I missed? Something that we could highlight?
I would even add, and what I would add is that it becomes much, much more important the earlier you are in the funding cycle. If you do pre-seed, seed, I think it's almost impossible for you not to work with the CVCs. If you invest in if you invest from a a 2 billion fund that only takes companies to IPO or pure private equity exits, and you assume that you're gonna invest across 8 different rounds, then I can see a world where you don't work with them. But pre-seed, seed, and even Series A, I mean, there's not a logic where you don't work with them, especially in our field, which is climate tech, because things take so much longer than your fund life cycles allow you to do. So you need to have a logic, a strategy on how you build the companies that you invested in, and how you build them, and how you build the exit pipeline. And to assume that your founders, however talented they might be, will have the exact same time that you do to work on these relationships is folly, because then they will not work on their main line of business. And that's where on active ownership and why your specific VC strategy makes so much sense. And that's where founders are also extremely grateful for you to do the legwork for them in that setting.
Cool. Kadri, let's just check in to see if there's any questions or any comments pending that we should take here before we take the next final.
I was just looking up that. So currently not. So everybody, do you have anything else you'd like to add, ask, comment on the topic, or should we move on? At the moment, seems quiet.
Good. Well, let's dive into the last part here. So one, I mentioned the number of CVCs that I've worked with, and if I go back maybe 6 or 7 years, a lot of the corporate strategy teams and the corporate innovation teams that I met and I've worked with as an advisor, many of them were incredibly unprepared for what a CVC actually is. It's been getting better, but there's one really amazing source that I read everywhere, and this is for TDK Ventures. TDK Ventures is the venture arm of the Japanese material sciences company TDK. And this gentleman is Nicolas. He's French, but he kind of got the gist to start building the TDK Ventures corporate venture arm a couple of years ago. And what was really interesting was when they decided to kind of get this off the ground, he was thinking, okay, he went through some of the 500 unlocked programs in Silicon Valley. He started getting an understanding of like what is venture capital, and he wanted to bring that back. And his starting point was, if we're going to do this, we have to do it really well. And we want to do it as if we were competing in the Olympics. We are not going to do it as just another corporate activity. And he hired a gentleman called Paul Holland, currently a partner with Mach 49 in Silicon Valley. It's a growth consulting firm. And he basically became the in-house entrepreneur in residence, coaching the team through that building and setting up. And you can find a lot of material online of how Nicolas and his team found a market opportunity, built the thesis, pulled the team together, developed the investment strategy, raised their LP funding internally from the chairman of the board, which was not an easy task, but got it done. And now I would say that they are one of the most professional, I would say they're one of the most proficient, and I would say they're one of the most successful corporate venture teams out there. And there are many good ones, but there are struggling. So I want to show you a couple of things. So we're not going to go through all the details here, but some of the work that we've been doing, and I'm happy to share this afterwards, is we have built out a pretty large kind of work package and toolkit for helping companies build up their corporate venture strategies and the corporate venture teams. Now, obviously, I mentioned that professionals, they don't really need this. They have all the setup internally. I mentioned the group that I call the learners. They really like this and they really take to it quite quickly. And then I have the ones that I mentioned as, very unlikely to be successful. And they have a little bit more sort of love-hate relationship with this. But some of the things that we do, and also you guys can do, is basically become an advisor, become a partner, become a trusted partner, become a strategic partner to the corporate venture teams. You don't build them consulting hours, but you build relationships that will be converting into LP commitments, be converted into deal flow sharing, and hopefully be converted into co-investments and follow-on investments down the road. So the first one is this CVC investment thesis canvas. That is a super simple canvas for setting up a CVC fund. So I'll do a quick example here. I'm just gonna take a EU utility. I'm not gonna name it. So let's say that you have a European utility company, along the lines of Sunly, but less innovative and less ambitious. Corporate venture capital thesis. You can set it up in like 2 minutes. And obviously you would have to, make it more relevant to whoever you're working with, but it's very quick and simple. Then we're moving into slightly more advanced material. This is what we call a CVC setup canvas. We're not going to go through the whole thing, but this covers all the key pieces that we believe that you need in a corporate venture capital strategy. Why, what, how, and how. Strategic rationale, impact, industry trends, thesis and capital, domains, deal-making, decision-making, ownership, leadership, success, network, and partnership. There's a lot of things that we find very few CVCs actually think about. And as a consequence, they kind of learn while working, while they could have been more thoughtful in terms of setting up. So we've worked on multiple CVC setups with. We also have the CVC strategy index. Then is like a super simple crossing off. What is the mandate? And Rasmus mentioned, is it a strategic fit or a financial return or both? Investment thesis, focus, fund size, target returns, deployment speed, a number of investments, target stages, the ticket sizes, valuation, how we work with co-investors, how we develop deal flow, do this, DD methods, decision time, and so on and so on. And what I found is even this very, very simple worksheet really causes some of the corporate venture teams to reflect and say, we haven't really thought about this. These are great questions. These are difficult questions. We need to go back and think more deeply about this. So there, I think a lot of things that we can do as venture funds to work and partner with CVCs and corporate funds. And you can work with them on strategy, on deal flow, on due diligence, on investment memos. And I would encourage all of you to really try to lean into that partnership mindset and find and work with corporate venture teams that allow you to learn together, work together. You may call it an open book policy, where you are becoming, a part of their advisory network, more than you are the small VC trying to raise a few bucks. So I think for years to come, corporate venture teams will be very important in the European ecosystem, and they are already very important in the Nordic ecosystem. And I think that all of us can do a lot more in terms of partnering with them and working with them in many, many different ways. Rasmus, we are almost ready to close out. What are some of your kind of concluding remarks in terms of how to successfully work with CVCs?
I think the most important part is understand what the partners of the CVC are want, or whether there are partners, and who makes decisions and why. Because in the end, you don't I have a fundamental belief that like nobody does things because they're told to do it because they like it, but you also have to understand on what are their own success metrics. And like you just showed in the really simple canvas, which I think is actually very useful, much more useful than it is hard, on the level that that why did they set up this, right? And it's completely logical. I mean, if you were doing this for Sunday, our number one reason was financial return, and our number two is to grow the ecosystem around this region, and number three is to learn about new tech, right? But it's very important for you to understand directly, because then you know how to engage with them and you know what they want out of it, right? And to align on this level, because you'll be working with them, like you mentioned, across multiple segments of the fund timeline, whether it's as LPs initially, and then deal flow and follow-on investments, or almost every single large CVC also runs an accelerator of some kind, which is actually a quite good deal flow for VC funds, because unlike traditional accelerators, they don't even usually take an equity stake. They mostly take a right to invest at a later stage, kind of a logic behind it, whether explicit or implied. And the third is that they are something that you should track as your exit timeline comes online. So yeah, I completely agree with what you highlighted, and how active you should be in working with CVCs across the fund life cycle.
And
So
not
we have
only
one question.
in the Nordics. Yes, wonderful,
Yeah,
fantastic.
not only.
Fire away.
So the question is, what is your recommend on allocations for follow-ons? I have noticed that many funds underestimate the level of follow-ons needed in cash flow negative startups. And then there's a comment from Indrek as well. Good point on collaboration of funds. Looks like particularly new managers try to outcompete rather than share and win. Silicon Valley is more collaborative in this sense. But yeah.
Yeah. So obviously, I fully agree with the statement, and I wish for more collaboration. In terms of follow-on, I mean, this is really a question of strategy. In our funds, we have had everything from zero, like we do not do follow-on. And there are very successful funds like Acrobat Ventures in Europe that follows the zero follow-on policy. And then we now have 40% in our fund number 3. And some of the funds that I really look up to in Europe, they have up to 60% for follow-on. So there's no specific answer, but I think my gut feeling these days is probably around 50% reserved for follow-on.
For me, like Chris said, it depends on strategy and depends on the industry. So we as well started with the 0 in Fund 1. Then we went to 50% in Fund 2, and then 60% in Fund 3. Why? Because we constantly moved earlier down the line, and the capital requirements went higher. So you wanted to bet more on your winners. Let's put it this way.
Yeah.
Great. So let's wrap it up. We are totally in time. It's noon, as promised. So maybe some final closing words, and I hope that everybody can reach out to both of you when they have, additional comments, questions, want to do something together, participate in the masterclass, as you mentioned, Chris. So there are different ways to collab with you both in the future as well.
Absolutely, and I mean, first of all, thank you for the invitation. And second, I would love to connect and keep the conversations going. And I have on my screen here, if we can share the invitation for those of you that may be interested in joining our January. We call it boot camp. That's how I met Rasmus some years ago, and we've also set up a complimentary 80% discount because we'd love to have more people from this ecosystem joining. So for those of you that are interested, you can look it up at strategytools.io, and then go to events and Fund Manager Bootcamp, and then we have the 80% discount. But most importantly, let's connect on LinkedIn and let's keep the conversation going. And thank you very much for the invitation.
Thank you so much.
And for me, I literally cannot state enough. Do attend the bootcamp. it paints a different picture. And the second, don't get discouraged about the math. The math is hard on a VC fund, but realize that there are many ways how you can enter the VC ecosystem and the startup ecosystem and grow this. And it doesn't always have to be that it's nothing and then you do your first fund. Beginning, working as a consultant with CVCs, working as a consultant in VCs, doing angel investing, and then seeing if this is something for you makes perfect sense because, like Chris said, this is 22. Did you say 22? 22 years of your life. So if you start when you're 30, you're going to finish when you're 52. This is half your career given the life expectancy.
Great. Well, until next time, and thank you so much once again, and everybody have a great day.
Thank you.
Thank you. Bye.
Bye.
Bye.